Hey there, Iguanas. Iggy here, and boy do I have a treat for you today. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with a total of 410,000 reads. Imagine having a crystal ball that could reveal the future of Singapore REITs in 2024. Well, I may not have a magical orb, but I've got the next best thing, the panel of REIT gurus ready to spill the beans. Picture this: you're an investor trying to navigate the wild world of real estate trusts. Interest rates are rising, the economy is shifting, and you're wondering where to put your hard-earned cash. Fear not, my savvy friends, because in this video, we're going to uncover some serious gems that will help you make smart moves in the REIT game. I recently reviewed the podcast by the Financial Coconut titled Exploring the Prospects and Opportunities for SG REITs in 2024. And let me tell you, these folks know their stuff. They dished on everything from the impact of interest rates to the hottest sectors to watch. But here's the best part: you don't need a PhD in finance to understand their wisdom. I'm going to break it all down for you in a way that's easy to digest, whether you're a seasoned investor or just starting to dip your toes into the REIT pool. So, grab a notepad, get cozy, and let's dive into the juicy details together. Trust me, by the end of this video, you'll be armed with the knowledge you need to make smart investment decisions and potentially boost your portfolio. Are you ready to see into the future of Singapore REITs? Let's do this. First off, let's talk about interest rates. They've been rising, which can be tough for REITs. Interest rates have been on an upward trajectory, which can pose challenges for REITs. This is because REITs often rely on debt financing to acquire properties, and when interest rates rise, the cost of borrowing increases. This can squeeze profit margins and make it more difficult for REITs to deliver attractive returns to investors. However, there's a silver lining. It appears that the peak of this interest rate hike cycle might be behind us. Financial experts are predicting that we could see interest rates start to decline. However, they caution that rates are likely to stabilize at levels higher than those seen pre-pandemic. This is a crucial point for REIT managers to consider in their financial planning. In this new normal of higher interest rates, REIT managers need to be savvy about managing their finances. This could involve strategies like refinancing their loans at lower rates where possible, or focusing on properties that can generate higher rental income to offset the increased financing costs. They might also need to be more selective about their property acquisitions, focusing on those that can deliver strong returns even in a higher interest rate environment. In the dynamic world of real estate investment trusts, REITs, one of the key strategies that managers are employing is a thorough evaluation of their property portfolios. This involves a meticulous review of each property's performance, taking into account factors such as rental income, occupancy rates, and maintenance costs. In some cases, they might identify properties that are underperforming or not yielding the expected returns. These could be properties in less desirable locations, or those that are facing high vacancy rates or maintenance issues. In such situations, REIT managers might decide to sell off these properties. The proceeds from these sales can then be used to acquire new properties that have better potential for high returns. This could include properties in prime locations, or those with strong tenant profiles. Alternatively, the funds could also be used to enhance existing properties in the portfolio. This could involve renovations or upgrades that can attract higher-paying tenants, thereby increasing the rental income. For instance, a commercial property could be refurbished with modern amenities to appeal to multinational corporations, or a residential property could be upgraded with facilities like a gym or swimming pool to attract higher-end tenants. In addition to this, REIT managers are also exploring ways to develop new properties or improve existing ones without incurring excessive costs. This could involve strategies like joint ventures with other developers or leveraging government incentives for property development. They might also look at sustainable building practices that can reduce construction costs in the long run. In essence, REIT managers are constantly looking for ways to optimize their portfolios and maximize returns for their investors. This involves a careful balance of acquiring new properties, enhancing existing ones, and disposing of underperforming assets. It's a dynamic process that requires a keen understanding of the property market, sound financial management, and strategic decision-making. As an investor, it's important to understand these strategies and consider them when evaluating the performance of REITs. Another big topic was ESG, environmental, social, and governance factors. Environmental, social, and governance (ESG) factors have become a significant consideration in the real estate sector, including for real estate investment trusts, REITs. This is largely driven by a growing awareness and concern for sustainability among tenants, particularly large corporations. These companies are increasingly seeking to lease space in green buildings that are environmentally friendly and sustainable. Investing in sustainability can offer several advantages for REITs. For one, it can enhance the appeal of their properties, making them more attractive to potential tenants. This can help REITs attract a wider pool of tenants, including those who prioritize sustainability in their operations. In turn, this can lead to higher occupancy rates and potentially higher rental income. Moreover, sustainable properties can also contribute to tenant retention. Tenants who value sustainability are likely to prefer staying in a green building over moving to a non-green one. This can help REITs maintain stable rental income streams and reduce the costs associated with tenant turnover. While investing in sustainability might not immediately boost profits for REITs, it can provide long-term benefits. For instance, sustainable buildings often have lower operating costs due to energy efficiency measures, which can contribute to higher net operating income over time. Additionally, sustainable properties may also enjoy higher property values, which can enhance the overall value of the REIT's portfolio. Furthermore, demonstrating a commitment to ESG factors can also enhance a REIT's reputation and brand image. This can make the REIT more attractive to investors who are increasingly considering ESG factors in their investment decisions. In the realm of real estate investment trusts, REITs, due diligence is a crucial aspect for investors. This is particularly true when considering REITs with properties located in foreign countries. The performance of these REITs can be influenced by a variety of factors, including economic conditions, real estate market trends, and regulatory environments in those countries. For instance, there has been some discussion about the challenges faced by certain REITs with properties in China. These challenges could be due to a variety of reasons, such as changes in the Chinese real estate market, regulatory changes, or economic factors. However, it's important to note that not all REITs with properties in China are struggling. There are indeed some that have managed to navigate these challenges successfully and deliver solid returns to their investors. Therefore, it's essential not to dismiss all China-based REITs based on the performance of a few. Instead, a more prudent approach would be to delve deeper into the specifics of each REIT. Look at the REIT sponsor, for example. A strong sponsor with a good track record in the real estate industry can often provide a level of assurance about the REIT's management and strategy. Additionally, consider the track record of the REIT itself. Has it consistently delivered good returns to its investors? Has it managed to maintain high occupancy rates for its properties? Has it demonstrated resilience in the face of market downturns? These are all important factors to consider. Lastly, pay attention to how the REIT engages with its investors. Good investor relations can be a sign of a REIT's commitment to transparency and accountability. This can include regular updates on the REIT's performance, clear communication about its strategy and plans, and responsiveness to investor queries. As we look ahead to 2024, the outlook for Singapore real estate investment trusts, REITs, appears promising. Despite potential challenges and uncertainties in the economic landscape, there are several reasons to be optimistic. One of the key factors that could drive a bullish trend for Singapore REITs is the potential for interest rate cuts. As we've discussed earlier, interest rates have a significant impact on REITs' performance. Lower interest rates reduce the cost of borrowing, which can boost REITs' profit margins and make their dividend yields more attractive to investors. If the experts' predictions come true and we see interest rate cuts in 2024, this could provide a significant boost to Singapore REITs. Another potential catalyst for a bull run is strong earnings reports. If REITs are able to deliver robust earnings, this could increase investor confidence and drive up their share prices. This could be achieved through various strategies, such as optimizing their property portfolios, enhancing their properties to attract higher-paying tenants, or effectively managing their finances in a higher interest rate environment. However, it's important to note that the road to success may not be smooth. There could be bumps along the way, such as unexpected economic events or changes in the property market. Therefore, it's crucial for REIT managers to stay nimble and adapt their strategies as needed. This could involve adjusting their property portfolios, refinancing their loans, or exploring new growth opportunities. For investors, staying informed is key. This involves keeping up to date with the latest news and developments in the REIT market, understanding the factors that can impact REITs' performance, and doing their homework before making investment decisions. By staying informed, investors can make more informed decisions and potentially reap the benefits of the bright future that lies ahead for Singapore REITs in 2024. All right, Iguanas, that's a wrap. We've covered a ton of ground today, from interest rates and property management to sustainability and geographic diversification. The key takeaways? REIT managers are staying nimble, adapting to challenges, and seizing opportunities. As investors, it's our job to stay informed and make smart choices. Remember, investing is a journey, not a destination. Keep learning, keep growing, and don't be afraid to ask questions. If you found this video helpful, show some love by smashing that like button and subscribing to the channel. Your support means the world to me. Until next time, stay curious, stay invested, and keep on Iguana ing. Iggy out.